Most retirement plans are built while both spouses are still here. Two Social Security checks, maybe a pension, shared tax brackets, one household and budget built around two incomes. But one day, only one of you may have to live on that plan. The safe plan that worked for the couple suddenly stops working for the remaining spouse. One check disappears while housing costs the same. The surviving spouse brings in less income but still pays a higher tax bill. Medicare premiums can also rise right when the budget gets tighter. So the question is not just whether you have enough while both of you are alive, it is whether the plan still protects the remaining spouse if the higher earner goes first. Start with Social Security. For many couples, this is the first surprise. Let's say one spouse gets $2,800 a month and the other gets $1,600. Together, that is $4,400. But after one spouse passes away, the survivor only gets to keep the higher check. Their household income drops from $4,400 a month to about $2,800. That is more than $19,000 a year gone. Over 20 years, that missing check is almost $400,000 in income the household no longer receives. This is just the first piece of what I call the one spouse left test. By the end of this video, you should be able to run that test on your own plan. If one spouse is left tomorrow, which income stays, which income disappears, and which bills get worse. And that is before taxes, Medicare premiums, IRA withdrawals, or the cost of keeping the house. Once the survivor lives on only one Social Security check, the size of that remaining check matters a lot more. This is why the higher earner's Social Security decision is not just a personal choice. Claim early, you are not just shrinking your own check, you are also reducing the amount your spouse can claim for the rest of their life. The real question is not just, when should I claim? It is, if I go first, what income does my spouse get to keep? If you want retirement rules explained in plain English before they become expensive for your family, hit subscribe. Most couples never check the rules properly until only one spouse is left dealing with it. Keep that test in mind as we go. What stays, what disappears, and what gets more expensive? Social Security is only the first place the survivor's income can shrink. The next check disappears completely because of a pension decision made years earlier. When that happens, there is no second chance to reverse it. The surviving spouse is left with the same bills, but one less paycheck to cover them. At retirement, the pension paperwork usually offers two options: a higher single life check that stops when the retiree dies, or a smaller joint and survivor check that keeps paying after one spouse is gone. The single life check may pay $400 or $500 more every month. In the first years of retirement, that gap looks huge. And naturally, most couples take the larger check. But pension elections are usually irrevocable. Once that paperwork is signed, the choice is locked for life, and the survivor is the one who lives with it. Picture a single life pension of $3,000 a month against a joint and survivor option at $2,500. The couple takes the $3,000. 8 years in, the pensioner dies. The full $3,000 monthly check stops, but the cost of running the house remains the same. If they had picked the joint and survivor option, the survivor would still be collecting $2,500 a month for the rest of her life. Over a 15-year widowhood, that earlier choice could cost the survivor close to $450,000 in lost income. So the real question is not which option pays more this month. It is which one still pays when the pensioner's gone. That answers another part of the test: which income disappears completely. The next part is what happens to the income that stays. Even with the pension question settled, the survivor's plan is not clear yet. The next squeeze comes from the tax return itself. The survivor can have less income coming in and still keep less of what is left. After one spouse dies, the survivor will file taxes alone the following year. That sounds like a small change on paper, but it is not. The single standard deduction is roughly half the joint deduction. The brackets are narrower. The same retirement income that fit comfortably in the 22% bracket as a couple can spill over to 24% or higher when filing alone. Take a couple with $140,000 in retirement income, pensions, IRA withdrawals, both Social Security checks. As a married couple filing jointly, their federal tax bill might be around $22,000. Then the higher earner passes. The survivor still has the pension, the IRA withdrawals, and her own Social Security. Her total income falls to around $120,000 because the second Social Security check is gone, but her tax bill can still go up by several $1,000s. Less income coming in, less on what is left after taxes. This is why the survivor's plan must be tested on one tax return, not the couple's joint return. The numbers look very different once only one person is signing it. Traditional IRAs and 401ks can also make the single filer problem worse. Tax-deferred money can suddenly feel heavier when only one person is filing the return. Rather than treating it as savings, it is future taxable income. Starting in your 70s, the IRS requires you to withdraw a minimum amount every year, whether you need the money or not. If both spouses defer those withdrawals while they are healthy, the balance keeps growing. Then one spouse dies. The survivor inherits the IRA. The combined balance becomes her balance. The required withdrawals are still large, but the joint brackets are gone. A couple with $1.2 million in traditional IRAs at age 75 could have a required withdrawal around $50,000 a year. While both spouses are alive, that $50,000 fits comfortably in the joint brackets. Move the same $50,000 onto a single tax return, stacked on top of pension and Social Security, and a big chunk of it will get taxed at a higher rate. Same withdrawal, same balance, very different tax outcome. There are ways to soften this while both spouses are still here. Gradual withdrawals during the joint years, small Roth conversions. Some couples deliberately pay a little extra tax in their 60s to leave the survivor with smaller required withdrawals at 80. The point is to spread the tax over two returns instead of dropping it all on one. Now we move to another part of the test. Which bills get worse after income falls? Here is one of the strangest twists in the survivor's plan. The survivor can lose income and still pay more for Medicare. The premiums are not the same for everyone. Once your income crosses certain thresholds, you pay an extra surcharge on top of the standard premium. This is IRMAA. Think of it as a Medicare surcharge tied to your tax return. It is based on income, but the income threshold for a single filer is much lower compared to a married couple. After one spouse dies, the survivor can cross into the surcharge at an income level that never triggered a surcharge before, and Medicare does not use this year's income right away. It usually looks back 2 years, so the bill may show up later, after the survivor has already lost a Social Security check, adjusted to one tax return, and watch the budget tighten. This part catches most people off guard. The surviving spouse loses income and Medicare asks for more. One possible fix is Form SSA 44. After a spouse passes away, the survivor can ask Social Security to use current lower income instead of the older tax return. Ask Social Security to use your current lower income instead of the older tax return. Many surviving spouses never knew about it, but before the remaining spouse can manage taxes, Medicare, or housing, she must be able to get to the money in the first place. This is where retirement plans can break almost instantly. Bills do not wait for probate. The mortgage company does not pause for a beneficiary review, and the brokerage department takes weeks to process paperwork that was already correct. Most people are not aware that the will does not override the beneficiary form. Retirement accounts, life insurance, annuities, and transfer on death accounts all pay out based on whatever name is on the form. Exactly the way it was filled out, regardless of what the will says. Take a man who rolled a 401k into an IRA 15 years ago. He was between marriages at the time, so he named his sister as the beneficiary. Years later, he remarried and updated his will to leave everything to his new wife. But he never updated the IRA form. When he dies, the will says one thing. The IRA pays out to his sister. Your real plan is whatever the paperwork says it is, not what the will says. Not what you remember signing at the bank 15 years ago. And even if every account transfers cleanly, every survivor plan eventually faces the final piece of the test at home. Most couples assume the house is the safest part of the plan, especially if the mortgage is paid off, but the house is not free. Property taxes, insurance, utilities, maintenance, the occasional roof or HVAC repair, maybe an HOA. Call it $1,300 a month before any major repair shows up. The house may be paid off. That does not mean it is affordable. While both spouses are alive, 2 Social Security checks and a pension cover, that without much thought. Now imagine the survivor running that same house alone. 1 Social Security check, not 2. A smaller pension or no pension at all. A higher tax bill on the income that remains. Maybe a Medicare surcharge that kicked in 2 years after the death. And every fixed housing cost the couple always had. Some surviving spouses could spend up to 45% of their income just to keep the house running. That is before food, Medicare, medication, and anything else. The question is not if the survivor inherits the house. It is if one person can actually afford to live in it. Each of these mistakes is fixable on its own. The trick is to check them before it is too late. Before you think your retirement plan is flawless, run what I call the one spouse left test. Which Social Security check would remain? What happens to the pension? What does the tax return look like for one person filing alone? How large could the IRA withdrawals become? Would Medicare surcharges apply? Do the beneficiary forms and titles actually match the plan? Can one person afford the house, not just inherit it? If you can answer all of those today, your plan does not just work for two people. It also protects the one left behind. The goal is not to predict who goes first. The goal is to make sure neither spouse is left with a plan that no longer works. I'm Allison. I read the fine print so you don't have to. I'll see you in the next one.